Nick, good morning. How are you, man?
Good. Good morning.
I'm excited about our first round of what I'm calling News Pod with Nick.
News pod. I like it. Yeah.
Carlos and Nick News Pod. So we're going to do this every Friday. And the idea here is we're going to unpack a story or two or three from the weekly edition of the Free Toaster. If you're not already on the Free Toaster edition, please sign up. Go to thefreetoaster.com. We look at thousands of stories per week. We run AI against a scoring algorithm, and we Nick and I handpick 10-ish stories to put in front of you. And in this pod, we're going to go a little deeper on just a few of them. And today, Nick, we're going to talk about the Apple and Chase deal that just hit the wire on the Wall Street Journal yesterday, which I got comments from our readers that we were very timely in reporting, and they really appreciated. And now we get to peel the onion a little further. And I'm curious to know what you've learned since we published.
Yeah, we had to actually redo the edition, which is why we were a little later than we wanted yesterday, but we had to lead with this big story. Yeah, so I took some notes. Maybe just stop me when you think there's a place to stop. But, as reported by the Wall Street Journal, we've been following the story for a while, that JP Morgan Chase is replacing Goldman as the issuer of the Apple Card, Chase being the largest bank in the U.S. They're taking over a portfolio worth $20 billion in balances. And so first, if we were to look at the numbers, this transition is expected to take about 24 months. Goldman Sachs is reportedly selling the portfolio at a discount of $1 billion, which I think is somewhat unique for a deal like this. And maybe we can unpack that. But this deal allows them to exit a very painful chapter. Goldman's foray into consumer lending with the markets business really resulted in cumulative losses of over $7 billion. But by selling this Apple Card program, they free up roughly about $20 billion in capital. So this should help them. But this is also a drop in the bucket relative to their total assets. So I was really trying to find a bunch of sell-side research on this, and there's actually not much chatter, simply because it's just not going to move the needle for them. But for us and for our readers, it's like a big deal. So which is why I find that kind of fun.
Yeah, one thing that I just thought of as you were reading that, I remember when Goldman first came on the scene with Marcus, and this might have been probably, 7-8 years ago, something like that. I was at Credit Karma at the time when it was happening. And I was always kind of surprised by the pace at which they entered the space. Because I always see lending as kind of a slow and steady business. You issue loans, you see how they perform, you scale slowly. And they seem to be moving at a rate that was well beyond what I had seen before from like fintechs in the space. So I always looked at it with caution of, hey, are these guys getting over their skis and doing maybe too much too fast? And then when I heard about the Apple deal, I was like, wow, that's obviously super scale, one of the bigger Cobrand deals out there. So am I totally surprised to hear the consumer lending division didn't work out and that the Cobrand, and it didn't totally shock me, because the thing I could always observe from the outside was just the speed at which they were moving.
Yeah. I had a friend at the time move over to that side of the business, and it was like super exciting and fun, like well capitalized, can take on the neobanks, and just didn't do that well. So there's probably a different story there. But I'm really curious on like your take on why Chase wanted this, right? This is going to increase by some math that we found, by increasing, by acquiring Apple Card, it's going to increase their portfolio of net credit card balances by about like close to 8%. And then maybe the approach to risk is a little bit differently. Essentially, I think Chase believes that their infrastructure and data can allow them to manage these loans more efficiently than Goldman. I think one of the interesting things is it was a real operational burden for Goldman, and there was a bunch of, a few different lawsuits because they weren't able to meet dispute timelines and, dispute requirements as an example. And there were some unique deals, requirements from Apple where, all the statements were kind of set on the same date versus kind of staggered throughout the month, which, for someone like Chase is probably like not a big deal because they actually have massive infrastructure that they've been dealing with. But from a Goldman side, having not had done it before, having to build that, probably was a massive operational issue for them. But I'm curious, what do you think? Like, why Chase? What's so attractive about this?
Yeah, no, a lot of what you said crossed my mind, but to add to it, Apple, I think was it the third largest company in the world? I've lost track. They were the largest company in the world for a while by market cap. I know Nvidia's overtaken, and maybe there's some others now ahead of them, but Apple's a heavyweight, and big team, big company, probably very, very tough negotiators. And these co-brand deals have just lots of deal terms. I've seen some of them from the inside when I was at Capital One, and they take sometimes years to negotiate. So I've seen how intense those conversations can be. So part of it for me was, hey, someone chases a scale of organization that can stand up to the weight of Apple. Like I think they come into those conversations as peers versus Goldman, obviously a world-class financial organization, but in the consumer lending space, they were kind of a newbie. And I imagine that conversation was highly imbalanced with Apple carrying way more weight in those negotiations than maybe they should have for like a healthy co-brand partnership. So I see more balance here in this deal than I did with the Goldman setup. So I think that's one. But two, Chase, I believe I've never worked inside of Chase, but I've worked within co-brands inside large Fortune 500 companies. And it's a very different DNA when you're on the co-brand side. Because on the consumer side, it's a math problem. You're optimizing every mail send, every click on Google. It's really more of a numbers and math game. Versus when you get to the co-brand side, you need to have deep empathy for your partner and their goals and what are they trying to accomplish. And you mentioned earlier, Apple was asking Goldman for certain operational things that maybe were difficult and challenging for them. When your bread and butter has been co-brands for a long time, Chase works with Amazon and United and Marriott, like giant co-brand portfolios. And they've probably seen every flavor of request from a co-brand partner, and they probably have playbooks on how do they handle those things. Versus Goldman was not only learning consumer lending, they were learning co-brands within consumer. So there was just a huge learning curve over there within that org. So I see a lot more experience and sophistication in how to deal with a partner like Apple at Chase. So to me, the deal made a lot of sense when I saw it hit the wire.
Yeah, but it took a while. Like, I think we had a story a year ago. I think Barclays looked at this. Like, we covered it in a few different ways. So it is interesting that it took a while for us to come to fruition. And I think even this is like Wall Street Journal broke that they that they agreed on the deal, but it's still not quite public yet, too. I think the math was pretty interesting, probably behind the scenes on what that discount was. And kudos to Chase for being stewards of capital, being patient, and finding an opportunity when they could and taking advantage of it.
Yeah.
Just a few other things.
You hit on something else with like the raw numbers of the deal. It's interesting because and you mentioned Barclays, and I know they're very big in the co-brand game. If I were Apple, I wouldn't be surprised if they actually turned down a more lucrative financial deal with, say, a Barclays to get someone like Chase with the scale and like just maybe the more peer-to-peer type relationship they might get with Chase. I imagine it would be very different. It would be more in balance with Barclays. At least that would be my guess, because they just came through an experience where they probably leaned in very heavily in every negotiation with Goldman and maybe got their way, in quotes. But then if the partner can't sustain that business, if it doesn't also work for the partner, they've seen what happens when maybe they push too hard in one of these deals. So that actually might have steered them away from maybe some of the smaller brands.
Yeah, interesting. And just a few other notes that I have for me is I think this is also a deposit play for Chase. I think Chase plans to open up a new Apple savings account, replacing the existing program, which gives them a direct channel to acquire, the sticky, low-cost funding that, banks just generally love. And then just a few some of the notes that I took down, the economics were just not as strong for Goldman. There were high loss rates around, 6.2% in late 2023, aggressive underwriting, and I think about 35% of the loans kind of went to customers with low FICOs, like below 660. So yeah, I thought that was another interesting point that I put down.
Yeah, no, that's it. That actually made me wonder. I don't view Chase as a card issuer that does a lot of lending under 660, and this may have changed, but I'm it's making me wonder if maybe there was a subprime issuer that's not named in this deal that Chase is going to hand some of those subprime assets to. So and I'm actually seeing more of this in the industry, and maybe this is something we can cover in a future editorial, Nick. But I'm seeing a structure now where merchants are showing up and negotiating a deal with the prime issuer, say a Chase or a Capital One or an Amex or somebody like that. And then they're getting a second tier lender in the co-brand deal. Let's say under 660 is a perfect example, where the subprime issuer would receive those accounts. And then the third tier is actually a debit product. And there's a loophole right now with, I think, what's called the Durbin rule that's allowing debit issuers to charge full credit interchange. Why that matters to co-brand deals is debit cards can now pay very rich rewards. So from a consumer perspective, let's say, and I saw this recently with an airline co-brand, if I apply to a Cobrand credit card that has that 3-tier structure, my approval rate's 100%. I'm never getting declined. I'm either going to get the prime card, the subprime card, or the debit card. So now the merchant has a way better co-brand program because there's just 0 declines. And I'm seeing more of these tiered structure. It's being called credit orchestration in the industry. So I'm starting to wonder, did Chase orchestrate kind of a 3-tier or maybe a 2-tier deal here that we haven't heard about yet?
Interesting. That's fascinating.
So maybe more digging for us to do on that one.
Yeah.
Future. Cool. So we're going to wrap for this week. But if you like this show and you want to hear our takes on the news, every Friday, we're going to riff for 15 to 30 minutes. We'll pick a couple stories. Today, we just picked one just to get the ball rolling on the news pod. But subscribe here on the Free Toaster pod and the Free Toaster newsletter, and hope to see you next week.
Thanks, guys.